All right. Welcome, everybody, and thank you for joining us today. My name is Thomas Chen, and I'll be moderating this panel on restoring trust, how industry veterans are taking the lead. So we've got an exciting lineup here. We've got executives from both Bitstamp and BitGo, two of the longest running crypto companies created on the foundation of trust, security, and compliance. We'll be discussing on how to build back better by focusing on custody, regulation, and market structure. Before we begin, just a quick disclaimer. We're providing information here today for informational purposes only. We're not acting as legal or financial advisors or investment professionals. Any personal opinion should not be construed or relied upon as financial advice. We are not here to recommend any cryptocurrencies. Great. So why don't we go ahead and do a quick round of introductions. We'll start with James, and then we'll go, we'll start with JB, we'll go to James, and then Mike. Just a quick background about your role, what you look after, and about the company.
Yeah, hello everyone. So my name is JB Graffiam, I'm the CEO of Bitstamp. Pleasure to be with you today. My background, I've been in crypto since 2014, spending many years before in the financial sector and running our crypto exchange globally. And again, pleasure to be with you today.
Hey, James, I think your mic is not coming through.
All right, well, I'll give it a go while he's there. Hey, I'm Mike Belshie. I'm co-founder and CEO here at BitGo. We are a digital asset wallet platform and custodian in the crypto space.
James, any luck? Okay, no problem. Really quick background on myself, Thomas Chen. I help lead sales here at BitGo. So we'll start off with Mike and JB while James figures out the technical issue here. Tell me a little bit about the relationship between the two companies, Bitstamp and BitGo.
Sure, I'll take that. Actually really honored to have had the pleasure of working with the Bitstamp team. Actually, I think it's about 8 years long now, as both companies have grown and expanded through the crypto space. We started working together back in early 2015, I think it was 2014, when Bitstamp was looking to bring in multi-signature wallets to help increase the level of security that they had on their platform, and they chose the BitGo wallet platform. And in those days, that was just Bitcoin only. They were supporting other assets also. From our side, at the BitGo side, we've always had this non-custodial, 2 out of 3 multi-sig wallet, and we've been expanding the service across lots of different coins over the last 8 years. Today, we support, something like 25 different blockchains with a combination of multi-sig and then also now MPC threshold signatures on some of the blockchains. But then they enjoy, using the policy management on the back end of that. And then also we've expanded into custody. So anyway, it's been a privilege to watch Bitstamp grow and be just a key part of the entire ecosystem for such a long period of time.
Absolutely, Mike. I think we have been, very close partners for almost a decade now, where, Bitstamp has been looking for best-in-class custody solution to expand our business globally. And as you mentioned, early days were probably a couple of assets, on the exchange, and now we have nearly 80 assets that we can offer to our clients globally. And as you mentioned, what was very key in our decision-making process and partnership is to increase security and safety on the platform. And basically, this is the partnership that we have been developing over the last decade, almost the last decade.
Fantastic. So we'll start off with a quick question around market structure. So FTX, as a community, we're still piecing together exactly what happened and the scope of the fallout. But one thing that is clear is market structure in crypto is still broken or still needs to evolve. We'll start with JB. What is your view on what needs to be done to improve the crypto market structure, and what is Bitstamp doing differently?
Yeah, sure. So I think the starting point of Bitstamp back in 2011, when the company has been established, where we bring today more than a decade of experience in crypto, what was fundamental at the time was to build, a fiat payment access to our clients, which means that today we have a portfolio of nearly 20 banks that we work with to offer crypto access to our clients globally. Also, our risk appetite, over the last 10 years has been quite low, in the sense that we have been very selective in working with our partners when it comes to custody, of course with BitGo, but we are also working with best-in-class providers for technology, like, we work with NASDAQ for our matching engine on the platform, also with AWS as part of our infrastructure. Also, we have enhanced partnerships in the field of insurance to offer the maximum, I would say, safety to our clients. And most importantly, we have a portfolio of 50 licenses in the world where we comply with local regulation where we are operating. So our DNA has been driven by regulatory and proper risk management to offer the maximum safety to our users. And because we have a low risk appetite, we have not been exposed to FTX, for instance, in the last couple of weeks. And because we are a trusted platform, and because probably we do the infrastructure in a way that it's properly managed, what we have seen over the last couple of weeks is an inflow of clients to the platform looking for protection, looking for safety, and making sure that the exchange of their choice, which is Bitstamp, is offering, trust, but also high level of protection. We are not lending the assets of our clients. All the assets are safeguarded and fully protected, which means that that's probably the way we should be operating a crypto exchange in a very trusted manner, where best-in-class providers and also very effective risk management capabilities. We have 1/3 of our people working in risk management, legal, regulatory, compliance, information security, and that's really helping us to offer crypto access to institutional clients, but also retail clients in a very, very secure and safe manner.
Thanks, JB. Certainly, as a major retail hub, it's interesting to see how you guys are in this wake of FTX, how the business is quickly changing, not only for yourselves, but how your partners may have different standards or how the regulation is coming down, especially for Bitstamp, who operates globally around the world. Similar question to you, Mike. What is your view on what needs to be done in the crypto market structure to improve, and how is BitGo playing a role there?
Yeah, the FTX failure, I think, caught most of the industry by a bit of a surprise. Definitely shows that the level of diligence that's gone into some of the early companies and lack of regulatory monitoring has allowed some to operate in shockingly fraudulent ways. So look, first off, the FTX failure was that of a criminal activity. It was fraud. It was not digital assets or crypto failing in any way. It was actually humans failing. But it does highlight the need for a better market structure. And I think one confusing point that hasn't been fully addressed for crypto is, like, where do you allow for risk to exist in the system and where do you not allow it to exist? And in the case of FTX, there are actually two companies that failed simultaneously. So Alameda Research, which was a proprietary trader / hedge fund type structure. These types of companies exist in both crypto and non-crypto markets, and they take great risks, and they only take on qualified institutional investors, and having them fail is actually acceptable. Nobody likes it, of course, but we had Archipelagos, right, from Bill Huang's company, not related to crypto at all, just about a year ago. Similarly, big hedge fund, it fails. Sometimes there's concerns about contagion from those things, and that does need to be contained. The other side of FTX, however, was an exchange, and this is part of trading infrastructure. This is part of the market structure that we have, and when it comes to market structure, we need to make sure we don't have untold risks. When you're talking about broker-dealers, exchanges, custodians, clearinghouses, market structure defines that the risk is clearly identified across each of these types of parties so that investors know that they can invest with confidence and there's not untold risks behind the scenes. And so in traditional markets, that's a heavy regulatory burden that makes it happen. In the crypto markets, I think we will be successful in using digital assets and tools and blockchains to make it more transparent and lower risk. But we do still need to make sure that these types of companies or entities are not taking those risks without some oversight. So, there's been a lot of talk about proof of reserves as a way to prove that an exchange has the assets that it's supposed to have. Well, that's partial, right? So you can prove you have reserves on chain. There's a lot of activity to be done there, but you can't prove a non-existence of liabilities. And that's really what happened with FTX. They had massive liabilities, that nobody had disclosed. There was no regulator overseeing it. There were no audits there. And they had created this, friendly relationship between their sister company, Alameda, and FTX in an undisclosed fraudulent way. All right. So anyway, when I think what we need to take much more seriously, like right away, is how to make sure that the risk is eliminated from market structure participants, and then probably also expanding that market structure.
And what does that look like in the scope of the BitGo Bitstamp relationship? Is it such that BitGo operates as the core qualified cold wallet custodian, and Bitstamp operates what BitGo's DNA is security, and Bitstamp's DNA is this retail hub as an exchange? Is that the best model, or an example of a better model moving forward for the industry?
Yeah, Tom, exactly. I would say, what is key for Bitstamp is, aside from, high level of governance, is also to work very closely with, best partner in the industry. And what is very important for us, especially in our relationship with BitGo, is that, we can leverage an immense experience in custody, whereby, our exchange, where we are offering crypto access, we are effectively, connected to BitGo to offer a safe custody solution for our clients, directly. And we have been, in this partnership now for more than 8 years, almost 8 years. And we feel that, that's the best way for us to offer maximum transparency and also protection and safety to our users.
Just to expand on that a little bit, I think the market structure is something that we have to continue to build over some period of time. Remember, existing markets for equities and derivatives, those have evolved over decades. And the crypto markets are only a decade old, and it's going to take some time. Crypto markets also introduce new complexity. The technology actually is different. And then, of course, globally, we need to solve this problem. But I think regulators are a bit stymied by, they've got a lot of protections they'd like to have in place, and it's difficult to kind of prioritize like which ones matter the most. How do you solve the problems, all of the problems, but how do you kind of break it down into its subproblems? So for example, some regulators are worried about money laundering and terrorist financing, very legitimate thing to be concerned about. Others are looking at like, how do we make sure there aren't pump and dump schemes? How do we make sure we don't have front running? Also very legitimate things to worry about. And then there's another layer, which is just how do we make sure we don't have rug pulls? At the end of the day, FTX is the biggest rug pull we've seen. That's really what's happened here. So I think if we can help the regulators kind of prioritize these problems and address them a little bit distinctly, we will end up in a good place. In terms of preventing the rug pull, well, the first thing you want to do is make sure that you understand what's the activity being taken on by the various market participants. So I think a little bit of regulatory oversight that just verifies basically, what are the financials looking like? Where are the assets and liabilities, and what is the risk that's being taken? And then, like what BitGo and Bitstamp do, we have two parties that are actually involved with checking against each other for what are the client assets. So the custody assets stored in cold storage through BitGo, and then of course Bitstamp managing that and auditing it on behalf of their users as well. So you get kind of two views at the same asset, which is going to help make sure you can expose any errors or risks or frauds that are happening. And when you look back at other exchange failures of the past, I think we can learn from them, whether it was Mt. Gox or Quadriga CX. If you use this structure where you start to separate out the duties, you get a check and a balance, that would, if not completely mitigate the problem, at least help you discover it as soon as there starts to be a discrepancy, and not let the problem persist for months or years until even more investors are harmed.
Speaking of regulators, sorry, go ahead, Jeremy.
Yeah, just to add maybe one last point for Bitstamp, which is key for us, is that what we are trying to achieve there is really to offer maximum transparency and comfort and protection to our clients. And governance is very, very important. And of course, the control framework, working with, auditors, compliance teams, information security, is also very, very, very critical. And looking at Bitstamp, we are audited on an annual basis by a Big Four entity. So, really best in class also in terms of the audit activities, to make sure that, we can offer that level of transparency also to our users. On the top of the relationship that we have developed with BitGo, where we share, probably the same risk appetite, the same values, and the same way of running the business in an efficient and sustainable and very safe manner.
Thanks, JB. Speaking of transparency and safety and regulators of existing markets, let's shift the conversation a bit towards the role of a custodian and segregation of duties. So in traditional finance, the term custodian has a very specific meaning and specific obligations tied to a financial institution. The term custody in crypto gets tossed around quite loosely, right? It's also loosely defined. FTX provided custody, but rehypothecated assets, misused assets, commingled it with assets on the balance sheet, etc. I'll start with Mike. How do you define custody? And when in your blog post, you mentioned not all custody is created equal. What do you mean by that?
Sure. So look, we offer a custodial service it's a regulated qualified custodian. What that means is that a regulator is aware of the activities we take on, ensures that we meet certain standards, and comes and looks at our books and records and makes sure that they're all in compliant with BSA and other rules. But at the end of the day, custodianship is really about safekeeping first and foremost. And in other asset classes, we've stopped thinking about custodians per se, because actually safekeeping is fairly well understood in the U.S. stock market or in banks. But when it comes to digital assets, this is a really high concern. So first and foremost, it's about that. But second, okay, well, anytime you hire someone else to hold assets for you, you now have this concern about, wait, how are they operating? And of course, in our industry, you hear this phrase a lot, not your keys, not your coins. And from a retail perspective, that makes total sense. Now, from a business perspective, when you're holding money on behalf of other people, when you're acting in a fiduciary manner, that means you're on the hook, legally and liability wise, for taking proper care of those assets while they are, in your possession or custody, whatnot. You have to hold a higher bar, and it's a matter of looking at, who are the parties, what's the management team look like, what are the audits behind it, what's the technology behind it, and these are things you just keep building on. And JB mentioned a number of those as well. Like, audits aren't perfect, but actually they're really important, because that's how you get a completely outside look at what's going on, inside of that organization or entity. So when we provide custodianship at BitGo, we're providing segregated cold storage, meaning our assets at BitGo are not commingled with the client, meaning the client's assets are not commingled with other clients. So that it's very easy to find those assets, see those assets. And in fact, in the blockchain world, you can even verify on chain that those assets exist. Second, we provide bankruptcy protection. So, BitGo does not take, huge risks as a custodian. That's not our job. That's not our place. But if anything did happen to the business and BitGo should go bankrupt, our clients and their assets are bankruptcy remote from BitGo's assets, which means that they would get those assets back in a quick manner. And I think when you look at what happened with FTX or any of the other bankruptcies that have happened, like Mt. Gox, by the way, is still not settled 8 years after the bankruptcy there. Having that type of protection all the way down to the end user is something that we would like to get to as an industry. So anyway, custodianship, that is, not real custodianship. Look, anyone can take digital assets. Like, I could take your crypto into a wallet that I hold, Thomas, and I would, just as an individual, be now a custodian for you. But you would not have bankruptcy protection. You would not have segregation of funds. And hopefully I'm not going to rug pull you.
Yeah, I think as this space evolves, especially from the fund side, we saw a lot of institutions whose funds are still stuck at FTX, right? And those who we thought did their deliberate care of due diligence fall short of that. So I think as we move forward, the LPs, the investors in funds inside these institutions, they will care about custody, right? What is real custody versus fake custody? And I think they will start to demand more of a regulated and qualified custody from this perspective. JB, you mentioned for Bitstamp in your business, you guys approach it in a very safe, secure way, obviously low risk angle, no leverage. Can you tell me a little bit about how you see custody evolving in this context as well?
Mm-hmm. Yeah, so with our portfolio of licenses that we have, I mentioned earlier, we have 50 licenses everywhere in the world where we are operating, and of course, we are sharing our custody model and custody setup with each of the regulator, in full transparency, which means that the proposition that we are offering to the market is also vetted by the regulators. They are reviewing our model on an ongoing basis. They make recommendations and suggestions, really in a spirit of offering maximum customer protection to our users. And also that model is also, as I mentioned, we are audited by a Big Four, is also reviewed and audited on an annual basis by our Big Four auditors, which means we are very transparent with regulators. In a way, we are structuring our custody proposition. This is audited on an annual basis. And what is key for us as an exchange, and if we make the comparison with the traditional financial sector, is that the money of our clients is segregated and safeguarded, versus the assets of Bitstamp, where it's not commingled. And this is a key point also, is that the money of our clients is their money, the fiat, but also the crypto. And why it's important, it's because when we are doing our due diligence in the past, that's really the objective we are trying to achieve, whereby the money of our clients remain the money of our clients. We don't lend their money. It's not commingled, and it's with Bitstamp money. It's segregated and safeguarded, and this is really the key point for us as part of our custody model. And that's really the model which Bitstamp as a regulated exchange we foresee for the future. That's really the model that we should push to the market moving forward, to allow maximum protection and make sure that our clients and clients in the ecosystem feel that their assets are protected and very safeguarded.
Got it. So just to summarize, the BitGo Bitstamp combo is one that offers regulation, security, and max protection. Assets are not commingled. We do not rehypothecate funds or provide leverage. And obviously through BitGo, Trust South Dakota, it's bankruptcy protected against creditors. Let's shift the topic towards what's to come. How has the business changed? For example, we certainly had views on what we would be doing this year before early November when FTX happened. You mentioned earlier, JB, that you saw a lot more inflows. Has there been a pickup in interest of different use cases? Are there maybe waning interest in other use cases? Are there certain pickups of interest in traction in certain products? How do you see that evolving through next year?
Yeah, I think 2022 with the crypto winter is probably 1 year of transition in the ecosystem. I mean, for Bitstamp, we have seen over the last 11 years different crypto winters. Some of them being very long, some of them being shorter. And I think the year 2022 is a year of transition where for us we are still building a lot of capabilities and products. So that we can be, fully ready when the market will come back at some point. What we observe for this year specifically compared to the previous crypto winters is that there is still a massive interest from institutional players to enter the crypto space, whether they are asset manager or banks, payment service providers. There are many companies, entities in the world building also their capabilities to be in a position to offer crypto access at some point to their end clients. And on the Bitstamp side, I would say we have developed a very elegant solution, which is a white label solution that institutional players such as banks or payment service providers can integrate and leverage our decade of experience in terms of crypto access, in terms of liquidity, in terms of custody, of course, with BitGo, and also, in terms of operation, whether it's KYC or AML, we can offer, a full end-to-end product, white label solution to offer crypto access to their end clients. And 2022 is a year where we have seen, very interesting inflow from traditional financial actors trying to build, their own access to crypto by leveraging, basically our technology and also our know-how that we have developed over the last decade.
And Mike, how about BitGo? What are some things that we're seeing pick up some interest? I know there was an announcement of a settlement network. Could you touch upon that a little bit?
Yeah, great. Look, there's been a number of initiatives that have been kind of out in the industry and kind of not yet fully solved problems. But when you have, failure events, they end up to being teaching moments for a lot of people. And I think this one was severe enough and I don't know, the third strike, so to speak, that we are going to see some learning moments from this. So there's a notion of a product called BitGo Network that we've been building for quite some time. And the idea is like, well, why is it that we're trading and having to store assets on exchange? And this creates a couple of problems for investors and traders. I mean, it exposes them to problems should the exchange have problems. And in traditional markets, exchanges never hold assets. Like NASDAQ doesn't hold your assets. And if they walked into the SEC and said, hey, we want to hold assets for our clients, the SEC would not even consider such a request. So BitGo Network is a opportunity to move assets out of the exchange entirely, yet still have access to liquidity on the exchange. The second problem it solves for investors, though, is that of having to pre-fund many exchanges. So today, if you're really trying to provide good market making capabilities or trading capabilities in the crypto markets, you end up having accounts on all of the major exchanges, and you have to have capital on all of them. This is very capital inefficient. And so using this type of structure, we can massively reduce the risk that investors are taking when they're having to, when they're using exchanges, and then secondarily, give them much more capital efficiency in terms of the overall markets. There'll be some tertiary effects, which are things like better connected networks between our exchanges creates more efficient markets. The prices will get more stable across assets, and we will be more globally connected.
That makes sense, Mike. I know we're coming up on the half hour here. I've got one last question. It's a little bit of a fun question. I'd love to get your views on both JB and Mike. So we talk about efficient markets, we talk about transparency, we talk about whether or not we can track this on-chain, centralized versus decentralized. There's one camp that obviously in the wake of FTX is saying it's championing DeFi more than ever before, saying this is the future because everything is more efficient, it's transparent, etc. And then there's another camp saying, oh, the regulator is going to sweep in and really transform the way that centralized players operate. How do you see these two dynamics playing out under the next year? Are we going to see more flows into the DeFi camp or more flows into the CeFi camp?
So it's a very interesting question. I mean, if we look at where we are today in terms of regulatory framework across the globe, is that crypto is almost a little bit more than a decade. It's like a nascent market, and it has taken time, for regulators across the world to define and to develop some level of regulation to try to regulate the ecosystem. And if we take the example of Europe, we are in it's kind of a regulatory puzzle at the moment. Each country has its own approach to crypto, and of course MiCA, which is market in crypto assets, which should come over the next 24 months, maybe 36 months, will build a couple of components which are very, very important. The first one is, level playing field for the actors in crypto. The second one, it will increase, transparency and protection to consumers, which means that, companies in the crypto space will have to develop much more risk management capabilities, which will create, more trust and which will trigger, I would say, market adoption. We will see more consumers, and as I mentioned earlier, we see a lot of institutions entering the crypto space. And I think for us as a centralized, crypto exchange, that's key that, we have a level playing field with some level of regulation, ideally across the world and not across a few regions, in order to offer, a safe, crypto access with the high level of consumer protection, and consumer protection will basically trigger the adoption. So I think probably DeFi and also us as a centralized exchange, we can definitely benefit and expand on the crypto market. I mean, it's not one or the other. I think it's probably different business models, different use cases that we can offer to the consumers, but also to institutional clients. Nevertheless, what is key for us is to have a smart regulation which will allow ultimately a massive adoption of crypto in our ecosystem.
Yeah, I think the question you're asking is like, who's the big winner here, CeFi or DeFi? I think in the short term, actually, some of the CeFi players are going to see a win. So like traditional banks, and traditional incumbents from the non-crypto world, there's going to be a lot of institutional guys that are looking for them to participate. Whether they're going to be able to meet that demand or not, I think is yet to be seen. But in general, there's a lot of institutions that would love to see, the Goldmans and the BNYs and the Fidelities really go deeper on crypto, and that'd be a big win for them. But then I think long term, actually, DeFi is the big winner. So we don't have the market structure really figured out for crypto yet, and it's been slow building it. Like I said earlier, everything inside of crypto is this verticalized, stack where the service providers, whether it's Coinbase or whether it's Binance or Gemini or anybody, they tend to be offering everything kind of in one big stack. And then you end up having to look at like, well, what are the risks there? And I think that's why people like Bitstamp, is because they've contained the risks and they're very public about not taking a lot of risk. But in order to eliminate risk from market structure, either it gets mandated and we all start doing it and separating parties, and this means separating out roles like who's doing broker-dealer activities versus clearinghouse activities versus exchange activities, or DeFi starts to step in and fill those voids. And I think the DeFi side can take out the counterparty risk and make it more public, even without any regulatory oversight. So obviously DeFi has a lot of work to be done in terms of making smart contracts stable and safe and ready for institutional access, as well as questions about how to handle compliance. But those technical problems will get solved, and then I think DeFi does end up being a winner in terms of helping reduce risk from the overall market.
That'll be a very, very interesting topic for our next webinar. But there you have it, guys. We're in the middle of a crypto and macro winter. I think we can all agree that this is not our first one, definitely not for Bitstamp or BitGo. We put our heads down, we build, and we champion the adoption of crypto through better market infrastructure, regulation, safety. This is a long-term game. So thank you, JB. Thank you, Mike. Thank you, everyone, for your time here today, and we'll see you next time.